Now, let's bring in Stuart Kaiser of Citi. Stuart, great to see you.
I don't
know if you want to answer our would you rather question, U.S. tech or China tech.
Yeah, he should be involved in that.
But, I mean, we want to get at this notion of should we be concerned about the valuation of the American AI trade at this point?
As far as China-U.S., I mean, if you told me 1 to 3 months, I can be comfortable being in China. You do have some big catalysts coming up at the end of October that you would assume would be supportive. But to Kara's point, I think 6 months out, a little bit too much uncertainty for me to really want to engage in China tech to the long side. To me, valuations, if all you're coming to me with is valuation, that's really a tough sell to me. You do have some catalysts at the end of October, though, and I would like some tactical exposure to that just in case.
Right. In terms of the build out of U.S. tech and data centers, are we getting into that period where we are looking bubblicious? I mean, it strikes me that just in the past couple of days, week or so on the street, there have been a couple of notes saying, are we in a bubble territory? I mean, like, when I see that sort of parade of stuff coming into my inbox, and I'm thinking, wow, people are really thinking about this.
Yeah, and the question is definitely coming up. I think AI power gen and that trade is probably the thing we have the most confidence in, frankly, from a Sharpe ratio perspective. To be fair, though, yeah, I mean, there is a lot priced in right now. People are, I don't want to say over their skis, but it's a pretty aggressive trade. And I think last time I was on was when Oracle reported, right? And the conversation there was great revenue forecast. They're not going to be able to find the chips and the energy to actually get there. So it's tough. I mean, the tactical valuation might look high, but if you believe that narrative, then you're probably earlier innings in that trade than you previously thought. So, yeah, AI power gen is a theme we're still pretty strongly behind.
Shifting gears, we've learned to discount government shutdowns, but for some reason, it just feels like people are more dug in this time. Hey, listen, this time tomorrow, it all might be done, but concerns around it, and what does it mean if it gets through the week, we miss a payroll, those types of things. The market moving?
Not too concerned about it yet. I think this thing would have to last, let's say, beyond a week or two, or you'd have to see the long end of the bond yield curve kind of respond to it. Otherwise, not too concerned about it right now. If it wasn't for a payrolls report on Friday, we probably wouldn't be talking about it, to be honest with you. So, yeah, tactically not too concerned right now. It would have to be something that, let's say, went beyond 2 weeks to really get our attention.
Stuart, when you talk about high-quality stocks, usually people think about high-quality stocks and they think the mega-cap tech stocks. How much have you strayed out of mega-cap tech to include high-quality stocks, and what are they?
Yeah, high-quality stocks, definitely something we like being in. To your point, 5 out of the Mag 7 would screen kind of high quality in our framework, which to us is comforting. We can tell you to be in quality, but you don't have to go totally away from that. What else is in there? The JP Morgans of the world are in there. A lot of the large cap financials would fall in there. There's a few, not too much healthcare, not too much staples, but you do have a lot of tech and financials, I think, would be the two biggest exposures. We do like that trade mostly because of the uncertainty around the labor market, but it's also nice that you have some Mag 7 exposure too. So it's get that, what 2 birds with 1 stone, so to speak.
So you just said something about the long end of the bond market. Are you saying in a shutdown that the long yields would be higher or lower in the long end?
I think I would be worried about a shutdown if it got the long end bond yields higher. So if people started to really talk about unreliability of government or fiscal deficits and stuff like that, I don't think we're there. But my point is, for the shutdown to matter, you would kind of have to trigger that type of discussion.
Well, that has sparked downgrades in the past, or at least moving, maybe not full-fledged downgrades, but credit revisions in terms of outlooks. Is that a concern? Does that come back into play with this sort of shutdown?
I don't think we're there yet. The big one would have been 2011. Back in 2011, the S&P traded at 11 times forward earnings, just for reference. I don't think we're anywhere close to getting to that. But look, you've seen 2 or 3 times in the last month, you had, UK 30-year bond yields moved right after Labor Day. It got the equity market's attention. The same thing happened with JGBs over the summer. So I don't think we're there. But I think for an equity investor, either you're shut down for an extended period of time, or the bond market is going to have to, poke you with a sharp stick and say you should care about this. And I don't think we're quite there yet.
And are you seeing any rotation out? Lessening exposure to tech and moving elsewhere as we head into year end?
You saw that in late August, but if you look at September month to date, the S&P has actually outperformed the Russell, and we've kind of come back to that. I think what's been interesting is S&P outperforming and Russell outperforming. The S&P equal weight is lagging a lot. So it's like the belly of the market is kind of under pressure, where people want to have tech on. They're trying to play this catch-up trade in small cap, but we haven't seen kind of the broadening within the S&P. So, look, a little bit here and there, but, the fact is those trades are still working. Look at Mag 7 this month, I think, is already up 7.7% or something like that.
But that catch-up in small caps, that's still on?
It's losing a little steam.
Yeah.
I mean, about 80% of that catch-up trade was valuation driven. I think now where you are with the weakening labor market, and now it's kind of a show me. Like, are we going to actually see some broadening out of earnings because we've done a lot of the work on the valuation side already? It does feel like it's running out of steam a little bit. We've even seen profitable small cap outperforming unprofitable, which tells you even in that area, people want to be kind of safe in terms of what they're buying.